Salaries for directors in 2022-2023. What should directors pay themselves in this tax year to minimise the amount of tax that they're going to pay? That's what I'm going to look at in this video. I do regular updates on tax and accounting issues, so if you'd like to be kept up to date, please subscribe to the channel, and if you like the video, it helps me and the channel. Thank you. So what should directors pay themselves? So in summary, I believe that you should pay yourself at a rate of £12,570 or £1,000 a month, £12,570 a year. And that's, I believe, for most directors, what is the most beneficial. As we go into the 2022-23 tax year, what has changed and what's not changed? So first of all, what's not changed is that the corporation tax is still at 19%. Income tax is still at 20%. The dividend tax that directors pay on their dividends has increased from 7.5% to 8.75%. And national insurance for employees has gone up from 12% to 13.25%, and for employers it's gone up from 13.8% to 15.05%. So there we go. So the reason that you might not want to pay yourself more than £12,570 is that then you pay income tax 20% plus employers and potentially employees national insurance, so you're paying three lots of tax, and if you add up all of those, it's way more than you pay with paying 20% tax plus 19% corporation tax plus the dividend tax. So it works out at about 26% as against 47%. So you're actually a lot better off when you add it all together, paying dividends, which I think is well known to have a high dividend policy. But there are exceptions. So what has been happening is that the gap between what direct shareholders get with their dividends and what people get as salaries, that gap has been narrowing because they're going to put the corporation tax rate up. But there's also another little interesting thing for small businesses. So for very small businesses, you don't pay, for small businesses, you don't pay the first £5,000 of employers' national insurance. And for very small businesses, that is more than they would pay in employers' national insurance anyway, because they've got very few other employees, and if they've got a little bit of part-time help or something, just mainly the directors. So for these micro businesses, they don't pay employers' national insurance, and that does change things a bit. It means that if you are receiving a dividend you're paying 19% corporation tax plus 8.75% dividend tax. So the corporation tax plus the dividend tax is something like 26 and a bit percent. But because you're not paying employers' national insurance, you're just paying employees, you're paying 20% as an employee plus 12%, plus an additional bit, 13.25%. So that's 33.25%. So that, I don't know, that 33.25 against 26% is not a huge difference. And there are reasons why you might want to pay it. And what are those reasons? Well, first of all, you might just want to have something like a £20,000 salary because it helps you get a credit card and stuff like that. You might not have reserves, so if you don't have reserves to pay dividends, then you can't pay dividends, so you might want to pay a salary, or if you're worried about not having reserves to pay your dividends, because you can only pay dividends out of profits. You haven't made profits, or you've got losses brought forward in the previous year, you might just have to pay a salary. And also, and if you're worried about your profits dipping in the future, you might want to have a definite salary so that gets paid regardless of the profits of the business. So those are the reasons. There is another reason. If you're a little bit old, so if you're beyond the retirement age, you just don't pay employees national insurance. So if you're got micro business, you're not paying employers national insurance, and you're not paying employees national insurance, actually the best thing to do is to pay yourself a high salary and low dividends. Who would have thought it? So there are advantages in working beyond the retirement age. I guess the final thing to this on the director's salary, which we never used to think about, is what happens if there's a furlough. Because if there's a furlough and you're paying a very low salary, then you don't get any furlough. So maybe if you're worried about a furlough again, surely there'll be no more lockdowns, but who knows? I thought that after the first one. If you have to furlough yourself, then all of that furlough was based on your salary. So if you got a higher salary, then you would have got more furlough money. So there you have it. In my opinion, for most people, you want to pay yourself a salary of $12,570. With the change in employees' national insurance so that it's at $12,570 as well, I think that the case has become stronger, but I've always believed you should, or sometime believed that you should be paying yourself at that rate, because you just pay less tax. You do have the inconvenience of having to pay tax on PAYE every month, every quarter, but you're paying less tax overall, and that's, in my experience, what most people want to do. If you've got any questions, you know where I am. If you want to know more about tax and accounting, please get in touch, and please keep tuned in to these videos where I'll do further updates, and if you subscribe, you'll find out what's been updated. Thank you for watching, and please like the video. It really helps me. Thank you.